US stocks and Treasury yields are up on election day as data suggests whoever wins is going to inherit a humming US economy. Meanwhile, the RBA holds and stays mildly hawkish, and New Zealand's unemployment rate is expected to tick up today. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner reviews the recent leap in ANZ's Business Outlook survey and looks ahead to the Reserve Bank's rate decision at the end of the month.
The hurdle for a 75 basis point cut is fairly high. It's typically only been seen in emergencies type situations where something awful has just happened and everyone knows it's going to be enormously negative for the economy.
But first, in 5 and 5 with ANZ. It's election results day in the United States of America. Ahead of those results rolling in, the S&P 500 was trading up nearly 1% at 4 a.m. Sydney Melbourne time on strong tech earnings, while US Treasury yields were also up 5 to 6 basis points, as data showed stronger headline October services activity. ANZ head of G3 Economics, Brian Martin, says whoever wins the election is set to inherit an economy that has skipped a recession and is growing.
The price action in bonds and equities is suggesting that whoever wins the election is going to inherit a strong economy. I think the rise in bond yields and also the gains we've seen in equity markets reflects an expectation that whoever becomes president is going to have an expansionary fiscal bias after the election, and that's going to fit with current strong economic activity on GDP, as we've seen in the ISM Services Index for October, that recession risks in the economy are really quite low at the moment. So the idea of a no landing is really gaining hold.
The US dollar index was about 0.3% lower at 4 a.m. Sydney Melbourne time, despite those higher Treasury yields. The Aussie dollar was up 0.73% at 66.32 US cents, while the Kiwi was up 0.43% at 59.98 US cents. Number 2. Against all of this, we have a US interest rate decision on Friday morning, Sydney Melbourne time. Brian says the Federal Open Markets Committee is expected to look through the politics.
Their twin mandate is to ensure full employment and price stability. Huge progress has been made on bringing inflation back to target, and the headline PCE deflator in September was at 2.1% year on year. So that's effectively back at target. Wage data is suggesting further progress on core inflation will be made in coming months, and the price component of the October ISM Services Index is now sustainably back at levels that prevailed before the pandemic. So on the measures that we are looking at for measuring the Fed on its dual mandates, slowing hiring and easing inflation, the door is wide open for the FOMC to cut rates 25 basis points.
Number 3, the Reserve Bank of Australia yesterday left the cash rate on hold at 4.35%, saying underlying inflation remained too high and that labour market conditions remain tight, despite easing gradually. ANZ Head of Australian Economics, Adam Boyton, says the post-meeting statement remained mildly hawkish, although some key forecasts were revised down.
None of these forecast changes are necessarily hugely dramatic, but they're all in, if you will, the same direction when it comes to the future path for interest rates. GDP growth was revised down. The unemployment rate peak was revised up, admittedly just a little bit. Wages growth was revised down. And the key trimmed mean inflation forecast just nudged down a little bit through the bulk of the forecast horizon. So language didn't change that much, but the forecast did take a nod toward a more neutral direction from the RBA.
Number 4. Ahead of the RBA's decision, ANZ Roy Morgan consumer confidence posted another small rise as households grew more confident about their current finances. The index is up 7.5 points since the July tax cuts kicked in. ANZ economist Maddie Dunk says inflation expectations have also been falling.
I think people do know that inflation is moderating, and you can see that in how they're responding about their inflation expectations. We are seeing this continual easing there and that trend downwards. The fact the 4-week moving average is at its lowest level in a couple of years highlights the fact people do think that interest rates are doing what they are intended to do in terms of bringing down inflation. So yes, I think there is this broad acknowledgement that rate hikes are working.
Number 5. New Zealand's September quarter unemployment rate is forecast by ANZ Research to rise from 4.6% to 4.9%, while the Reserve Bank is expecting 5%. ANZ senior economist Miles Workman says a reading that is 0.2 points either side of that shouldn't change expectations for a 50 basis point rate cut on November the 27th, although he says there is scope for surprises.
For example, we're expecting employment to contract 0.4% quarter on quarter as demand for labour dries up as the economy continues to stagnate. And essentially, if we were to see a much sharper contraction in employment than that, well, that would be a signal that perhaps maybe the underlying economy is just running a bit softer than previously thought.
Miles Workman there. Now, in our bonus deep dive interview ahead of that jobs market release, ANZ New Zealand Chief Economist Sharon Zollner reviews the October state of play for ANZ's New Zealand Business Outlook Survey. And the talk out there, albeit quiet, of the potential for a 75 basis point cut by the Reserve Bank in November.
So another strong month for the Business Outlook Survey. We saw business confidence rise another 5 points to plus 66. That's a fresh 10-year high. There was also a small increase in firms' expectations for their own activity, up 1 point to a very healthy plus 46. Now, of course, we do need to bear in mind what they are comparing to when they're saying whether things are going to go up or down. And firms are still reporting, the majority of them, that they are less busy than they were a year ago. But even that is becoming less negative now. So that's the first step, I suppose. There are definitely some firms that are flipping from saying they're less busy than a year ago to more busy.
And what are those expected outlook numbers showing us in terms of that correlation with GDP?
Yes, so the strongest correlation with GDP is actually in what's happened in the previous month, because firms obviously know that a lot better than they know what's going to happen over the next 12 months. And so activity versus 1 year ago lifted from a minus 19 to minus 11. It'd be good to see that back in the black. That'll probably be a while, but it's definitely getting there. But we did see that the retail sector was an outlier there. It actually gave up its gains of the last few months. That's interesting in context of the fact that consumer confidence actually gave up some of its gains last month as well. So perhaps those two things are related.
So pricing intentions have stopped falling. Is there anything to worry about there?
Yeah, so there's definitely some stickiness in the pricing intentions. In fact, they've risen for 4 months in a row. They are a lot higher than they were back in June, for example. So I don't think it's problematic at this point. It is still higher than it was before COVID, but it is perhaps just a reminder that these rate cuts we're all looking forward to are still conditional on inflation getting to where it needs to be. Now, of course, headline inflation is where it needs to be. It's a 2.2, but the domestic component of inflation, which tends to hang around to be sticky, that's still actually nearly 5. It needs to get down to 3. And you can point at things like rates and insurance, things that the Reserve Bank really doesn't have much responsibility for. And indeed, the Reserve Bank is pretty much carving those things out, which is why they're comfortable cutting rates now. But it is a rump of inflation that means, you're not really starting with a clean slate if we were to see any upward pressure on inflation from here. But I'd still characterise it as so far so good, but just not quite there yet.
So what are you expecting in terms of the Reserve Bank's next move, and what's the market pricing in?
So the next move from the RBNZ is rapidly approaching. It's in November. The economists are fairly unanimous in expecting a 50 basis point cut, and the market is there too, though they are pricing about a 25% chance of a 75 point cut. They've backed off a little bit. They were a bit more gung-ho on that before. But in our minds, the hurdle for a 75 basis point cut is fairly high. It's typically only been seen in emergencies type situations where something awful has just happened and everyone knows it's going to be enormously negative for the economy. That's not the case. I mean, we're cutting rates for a good news story in a way. It's sort of a why not cut rates because we've now done enough. I mean, in the context of this very deliberate recession, things are a little bit different, I would say. We're certainly not in an emergency situation. Yes, while the economy is in recession, some measures such as unemployment actually haven't risen as far or as fast as the Reserve Bank expected they would have by now when they stopped hiking rates back in May last year. But of course, we do have another read on unemployment, and that's going to be a very, very important piece of data. Most estimates I've seen seem to be fairly similar to the Reserve Bank's own estimate of a lift to 5%. But if we did see a number significantly over that, then I think the market would again move back to pricing much higher chance of a 75 basis point cut.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, November the 6th. Catch you tomorrow with further market reaction to those US election results coming in over the next 24 hours. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.